Hello, everyone, and welcome to the second session of the book reviews on Quantopian. And I am very happy, very honored. It's a great pleasure to welcome our guest, Victor Haghani, tonight to our meeting here to discuss his book together that he co-authored with James White called The Missing Billionaires, A Guide to Better Financial Decisions. And I just wanted to say a few words because I am going to basically ask that you please talk about your background yourself, about, what you did in the past and how up to the point where you came to the thresholds of making the decision of writing this book. But just wanted to say that Victor founded Elm Wealth in 2011, and I think that it started from what I have read as managing the family wealth and money, but then it grew to maybe a little bit bigger than that, extended the scale and scope of it. But of course, you worked with Salomon Brothers in 84, and he became the managing director in the bond arbitrage group there. And then in 93, you were one of the co-founders with Meriwether and Scholes and Merton of the long-term capital management. So currently you are in United States, but you also live in London part of the year. And so it must be good to alternate between those two places. I don't know. I've never been to Wyoming, and that's one of the
It's
places.
beautiful. You should come. I'm here most of the time now, actually. So
Oh, okay. Okay.
yeah. So really kind of full time in Jackson, and then get back to London a couple times a year. I'll be back there over Thanksgiving with our
Okay.
family, but spending like a month or so in London, and the rest of the time in Jackson and the US, pretty much.
Oh, I see. Okay. Excellent.
Yeah.
Excellent.
Yeah.
All right. So thank you very much again for being here. And if you could please start us with just a little bit of background about yourself and what you did and how it got you to the point where you decided to actually start working on this project and writing this book with James.
Sure. So, quick background. I was born in New York. My dad was Iranian, came to the States in 1941. My mom was born here and was an opera singer and a musician. And so I was born in New York, lived in New York, also lived outside of New York, up in upstate New York and in Pennsylvania. And then when I was 13 or 14, we moved to Iran. So I was going into ninth grade at that time. So we moved to Iran as a family and lived there until the revolution came, which my father did not see coming. What I think is really interesting, some really interesting lessons there, in terms of what was going on and in my father's decision making. And then kind of wound up in London eventually, really because my father thought that things in Iran were going to blow over and I'd go back and finish high school there. So it was like a little bit in transit. And then all of a sudden it was like, well, time is going on. So I finished high school in London and then wound up going to the London School of Economics. So afterwards, I got a job at Salomon Brothers in New York in the bond portfolio analysis, kind of fixed income quantitative research area. And then that led to a trading position working for John Meriwether and his group of proprietary trading for Salomon Brothers. And then I basically worked the rest of that career with John and the other colleagues going to found long-term capital management. And at that point, moving back to London, where I set up the London office for LTCM and was in charge of trading and risk taking for LTCM in London, and then eventually had a partner, Hans Hufschmidt, as well in London. And until it was a relatively short, LTCM was basically a 5-year kind of activity. And then I stayed behind after LTCM failed. And I stayed and helped liquidate the positions of LTCM on behalf of the consortium that had bought the portfolio. And then I took a 10-year sabbatical, and eventually this 10-year sabbatical where, I think the thing that was really interesting was, around the year 2000, 2001, I wasn't working anymore. And I realized that I had never really thought very much about how to invest my family's savings or thinking about financial decisions very much at all. I was, 38, 39 years old. And I had worked in finance and worked with all of these brilliant academics and practitioners, but we were focused on, like trying to beat the market, and we were focused on, particularly the fixed income market. And, I never thought about personal investing. It was all kind of wrapped up in institutional risk-taking and decision-making and investing. Looking back on it, I think it is just really fascinating that, people leave university, they go to Wall Street, and they get to be very productive and innovative and competent. But nobody ever there's really, as far as I know, there's really no process where, people that are in investment banking or sales and trading, where anybody kind of takes them aside and says, like, this is how you should be thinking about your own personal financial decision making, investing, spending, saving, etc. It's kind of like, well, probably everybody gets it. That's what the thought is, like, everybody gets it, but everybody doesn't get it. I didn't get it. And so anyway, so I started to think about what to do, and I looked around me and I saw that people like me were basically kind of doing this David Swensen Yale endowment model of investing, but just made no sense. But that's what I started to try to do because it seemed like the best thing to do. And it took me like 3 or 4 years of doing that to realize how inappropriate it was for an individual. It's interesting, Swensen wrote his second book. I forget what the name of it was. The second book, which was for individual investors, for household and for households, where he said first he had Pioneering Portfolio Management that talked about the Yale endowment model, and then he wrote another book that was like, forget about all that, put your money in stocks and government bonds and whatever. And it was kind of interesting that of all people that he wound up writing a good household finance book. And so as this realization that no, the Yale model doesn't make sense for an individual, I kind of went back and was thinking, geez, what did I learn at university? What makes sense? It was, and it drew me to indexing and wanting diversification, low cost, tax efficiency, transparency. And so I started to really become a devotee of Vanguard and indexing. And, but at the same time, I kind of felt like, what, I don't want to be totally passive. I don't want to wake up one day and like 60% of my savings is in Japanese equities because they've become because they're trading at a PE of 200. And so I wanted to have a little bit of eyes openness. And I felt that by being eyes open with regard to asset allocation, that I could use these low cost market cap weighted ETFs as building blocks, but be responsive in asset allocation to changing market conditions. And so that gave birth eventually to Elm Wealth, this business that I started in 2011 and has grown. And eventually my partner and Elm's current CEO, James White, became a client and then got really interested. I was always doing writing and sharing the thinking behind Elm. And then when James came on board, there was more writing. Somehow we started to really get focused on, that we were thinking about asset allocation and just this question of how should you decide how much stocks versus bonds should you have in your portfolio? Imagine you're just in this 2-asset world. There's stocks and there's safe assets. I don't even want to call them bonds. We've got safe assets and we have stocks. How much should you invest in stocks? Just a few days ago, I went on ChatGPT and asked ChatGPT that question. I said, I'm 62 years old. How much should I have in stocks? And it gave kind of the conventional answer, which is like, well, it depends, but at your age, it's okay to have 50% in stocks or 40% in stocks, or if you're more risk tolerant, 60% in stocks. And thinking about it like that is leaving out the very this very basic idea that, well, the amount that you should have depends on how attractive stocks are relative to the safe asset, how risky they are, and your personal utility function, your personal degree of risk aversion. It's kind of as simple as that. But nobody really thinks that way. And, let me stop there and tell me where you want me to go.
No. That's very good. Very, 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 very good to understand. Like I think it is very valuable to understand how your thought evolved in this process, where you got to the point where, because my understanding, I haven't finished the book yet. I'm kind of halfway through. And my understanding is that one of the main premises, one of the main messages or take home lessons or messages for the readers is that sizing of the investments is as important, if not more, than the actual decision about what or which investment vehicle you are going to use in order to get to your goals. And that ignoring that component of it is going to be detrimental, as perhaps evidenced by what we see in these missing billionaires who have should have been around us, especially from certain families in United States, perhaps around the world as well, because this should be a universal phenomenon. But this whole idea that brought you to that point, I was just trying to see if there were these ingredients already in your thought when you were even years prior to writing this book, that you were thinking about the primacy in some sense of the, I don't know if you like to call it primacy of bet sizing as opposed to other aspects of investment. But however you thought about that, I was just trying to decode that process, how you got to that
Yeah,
point.
so really, it's just something that I did not think about very much at all until, 10, 15 years ago. Yeah.
Okay.
So it's a very, something that I just wasn't really thinking about at all. And when I started to dig into it and started to read about all of the wonderful work that's been done, I was kind of shocked that I had never come across it, and that particularly ironically, that Bob Merton was at the center of the whole thing, and I was working, and he was my, he was, my mentor and all of that. And but what happened was, right, that at some point, around 1970, the whole idea of derivatives pricing, option pricing, all of that came up. The same people,
Yes.
and then that eclipsed everything else. So it was amazing to see, that here was Bob. What was Bob's first? I believe that Bob's first paper in economics, once he came to MIT, and his first paper in economics was on lifetime consumption and portfolio choice, which basically is like giving a very grand, big answer to this question of bet sizing. And then he continued to research like that, and then his students, right, his students were writing articles like that. So the students who became my friends, that were a little bit more my generation, his students, they all kind of cut their teeth writing those papers. But then all of a sudden it stops.
Mm.
And now everything is, contingent claims pricing and all of that. And that, is become so valuable and useful. And this whole other kind of choice theory stuff is left on the back burner. It's felt that it's too abstract, to take hold in the world of practitioners. The practitioners that would use it are more in the wealth management, private bank areas of the world, the financial advisors, and that's not where the money is. It's sort of in sales and trading, investment banking. And yeah, it's just really, really fascinating, to see these ideas. And of course, Bob and Samuelson, were far, far, far from the only people making tremendous contributions in the whole area. I know that. I mean, I'm just, I'm not that knowledgeable about the whole literature, but I know that, many people made these contributions. But it's amazing, open any finance textbook, any graduate level finance textbook, and where does it start? It's the first 50 pages or 100 pages are all expected utility, choice theory, all of these derivations. And even, amazingly, right? I mean, it's like, the CAPM, we have CAPM and all of that, is, that it's kind of amazing how, utility function is used in, in the derivation and so on. And then it's like, okay, we just kind of put it aside. It's like, okay, everybody's going to own some amount of the market portfolio, but we're not going to really spend much time discussing how does somebody decide where on the line to be. And of course, the utility function that was used is kind of a laughable utility function, right? It's a quadratic utility function that only locally makes sense because it was just a throwaway, it was like this throwaway thing. So it's really fascinating. I think it's just really, really, the whole thing is fascinating. And I sort of happened into it, I think, kind of by chance almost, you
Mm.
know, and yeah, it was funny that James was sort of thinking about a lot of the
Yeah.
same things. And I also, another person that was really instrumental in the whole thing was Andy Morton. So Andy Morton, you know, he was a bit of an academic first, and then now he runs all of trading for Citi. You know, Andy's known in finance, I guess, for the, what's it called, the who are the three guys that did the fixed income term structure model? Was Andy,
Oh,
right, Robert Jarrow.
Arrow and
It was
he
like
and
HJM,
he,
right?
yeah,
HJM.
yeah,
I forget who the H is. Anyway,
yeah.
so Andy was also like thinking about these things and helped me to learn and to think about this. We wrote a paper, Andy and I wrote a paper together
Oh,
early on as well, you know, just trying to make people understand like how simple this stuff is and how important. And you know, I think this idea of like, okay, you know, there's the investing process involves, you know, the selection decisions, the what and the how much decisions,
yeah.
right? And you know, I think that when you compare those two decisions, there's a couple of interesting things. You know, they're both important, but if you get the selection wrong, but the sizing right, you know, it's kind of sad, but you're okay. But you can actually get the selection right and the sizing wrong, and then you're bankrupt, which I
Yes.
think is amazing, you know. And then the other thing is that the selection, that in some ways, the selection is a competitive activity, right? Like, I mean, okay, if you're going to invest in index funds, you've given up, you're not doing the competitive thing. But in general, selection is this competitive kind of zero sum process where you're trying to select things, you know, that everybody else is trying to select the best things, and you're trying, it's like the most competitive sport on the planet. But the sizing decision is not competitive and it's easy, like, right, you know, that everybody can kind of get it right. And if you get it right, you know, everybody can get it right without anybody getting it wrong. Whereas like if you're an active investor, you can only be right if other people are very wrong. Not only wrong, they have to be very wrong, because they have to be so wrong to not only pay you your winnings, but you have to win enough to compensate for the extra risk that's involved in the active decision making. So you have to really win by a lot. You can't just win. It's not enough to just win a little bit. You have to win a lot, because there's this extra risk involved in the active decisions.
Fascinating, fascinating. No, what you were saying, and I will just make one more maybe intro into parts of this, and then I will let anybody who has any question for them to ask more questions, and then we get back and then we wrap it up around, 8:20 or so. So there is, so I was puzzled also because I know that there was an information theory, and you do mention all of these, and there is the work of Kelly, and there is the Kelly criterion, there was the work that perhaps Shannon started, aside from the information theory part of his work, of course, that is what he did. But then in communication theory, and also he was very much interested in investment in markets as well as gambling, direct gambling, and other things that he did, and the tools that he made and gadgets that he made. But Kelly was also in touch with him and wrote these papers. It feels like that and you alluded to this, that this kind of direction never really caught people's attention for too long. Is it, you think, because of this option pricing dominating the academia as well as, okay, academia I understand, because I think academia really likes to write more papers and more mathematically sophisticated papers, especially if it is in the field of mathematical economics or mathematical finance or computational finance. And option pricing and the methodology framework there really gives you like everything you like as a mathematician or as a theoretical person. But in the practice, the world of practice, did people not follow those directions of looking at this problem in a productive way in hedge funds and other places?
So yeah, I mean, this whole sort of Kelly versus expected utility thing is really, really interesting. And you know, of course, you know, I'm too young to know, you know, exactly what was going on. But the more that I've, you know, seen and dipped into it and all, you know, that first of all, you know, the Kelly, that anybody that's a kind of professional gambler, everybody seems to have been aware of Kelly, right? So, so like Kelly was really well known. Like, let's say that you have the Kelly criterion as one thing, and then let's say that we have this other thing called the Merton share, which there was no such thing as a Merton share, really. I mean, we talk about it in the book, but there's really no such thing as a Merton share. Like there's a Black-Scholes model, but there's not really, there's a Sharpe ratio, right? Like there is a Sharpe ratio, but there's not really a Merton share, even though, people like us are trying to talk more about it. And we didn't coin the term, it has been used, but it's not very popular. It's a rule of thumb. But it's something that like nobody knows at all, until, maybe some people reading the book now know it. But it was, but the Kelly criterion, sure, like everybody knows it. Although when we were starting to write the book, all of this was on Wikipedia. So actually, the Merton share, I mean, there's a lot of stuff. There's all of this literature was kind of on Wikipedia for what it's worth, 10 or more years ago, which is wonderful. So anyway, yeah, that's interesting. I think the Kelly criterion was really much more broadly known and practiced. Now, the Kelly criterion is a little bit like option pricing in that it really is kind of an answer. I mean, it is a definitive answer. If you want to maximize, the rate of growth of assets, then, you do this. You're gonna, if you want to maximize the log of wealth, then this is the strategy that maximizes the log of wealth, and it has nothing to do with preferences or risk aversion or anything. It just maximizes your rate of growth, and so it's much more satisfying, I think, to many people because it doesn't rely on some wishy-washy abstract set of preferences as evidenced by some unobservable utility curve, and then we have this whole war, this war that develops, between these people, which is just hard to really, know, what was happening in all of that, and you get this paper by Samuelson where he's really kind of like mocking. I don't know what was on his mind when he wrote it, the paper that's all one syllable, right? The paper, I mean, it's hilarious, but I think that it was kind of probably meant, maybe it was meant as like a slight, like, hey, you Kelly guys, you Kelly guys, maybe I'm going to write this paper with all one syllable words and maybe you'll understand what I'm talking about. And so it just got kind of, weirdly personal. And then this whole kind of personal thing got picked up by Taleb and people around Taleb as well. Taleb was already kind of anti-establishment, anti-modern finance. And so this was like another place to really, be anti-modern finance. And now we have this kind of weird ergodicity movement. And so it's really interesting. That whole thing is like a very fascinating. And we have this book called Fortune's Formula by William Poundstone.
Yes.
I don't know if you've ever seen that, and he really kind of, talks somewhat about, he certainly describes all of these characters, Shannon and Kelly and Samuelson and so on. But yeah, I think it's a really fun, fascinating thing with great characters, the Savage and, I mean, all these guys going back, Friedman, right? I mean, everybody was in it, once von Neumann kind of kicked the whole thing off in a way again. I mean, yeah, I mean, I know that there was a lot of stuff before von Neumann, Morgenstern also, but they really kicked it off again. So, I think it's a really fascinating area, and it has so many, there's just so many places where we need to be, that we need people to realize that risk is a cost, which is as meaningful, not as tangible, but as meaningful as a fee. It's like you're paying a fee, right? I mean, risk is kind of a fee.
Yep.
And, people say like, oh, you can't eat Sharpe ratio. I was talking to somebody and they were like, isn't it, the only thing you can eat is compound return. You can't eat Sharpe ratio. And I was like, yeah, I mean, that's true. You cannot eat Sharpe ratio, but what you eat is actually risk adjusted return. that you don't really eat, in a sense, I think it's more correct to say that you eat risk-adjusted return, you don't eat compound return, you certainly don't eat arithmetic return. And because risk-adjusted return is that return is the lowest return that we would accept as a certain equivalence to the risky portfolios that we have, the risk that we're taking. So yeah, anyway, I think it's all very, very fascinating. And so, yeah, I don't know how we decided, like the book was really this kind, we wanted to write the book. We went to Wiley, they were excited about it. And then we started to write it and we kind of failed, and we just stopped and we gave up. And we just thought we were never going to write it. Yeah, it was very, we found it really difficult going. I think that we didn't want to write a book that just started off with like, you should maximize your expected utility. And so we were just struggling with like, how can we make this book, interesting and not, really sort of obtuse and so on. And it took us a while. We gave up on it. And then, one day it kind of like, okay, maybe if we do it like this, it could be readable for people.
Oh, it's fantastically readable. When you say, I have heard all these things that Andrew Lowe, that I'm sure you know, Andrew Lowe always said that his publishers told him that for every, especially in books that, is more targeted towards public and layperson as opposed to professionals or the academics, for every formula that you put, you lose like 100 readers or something like
You
that.
lose half. Yeah, you lose half of your audience. Yeah, I think that's what they told. So I think the backstory of that is that's what they told Stephen Hawking.
Oh,
And
I
so
see.
I think in his book, maybe it was his book, A Brief History of Time.
Uh-huh.
So I think that he just put in like E equals MC squared, and that was it.
Beyond that, nobody will buy. Yeah, no,
Yeah,
that,
yeah, yeah.
but you started, I mean, I think that experiment that you mentioned in the book, that is highly readable, that one just wants to read the whole thing in one sitting. To know what happened, how would you go about this? What would you do? And you stop. You barely can hold yourself and do it for yourself and then go and see what the results were. And fascinating results, fascinating results. But that's yet another completely different conversation about the psychology of, how people make decisions and what they do or how they do it and what they think about risk, how they think about risk, how they perceive risk, how to model risk. I mean, I think that's really fascinating. And more and more that I study or I read this stuff as an outsider, as an engineer turned mathematician, when I read finance, initially, of course, you're fascinated as a mathematician by the mathematical theory. The nicer, the more beautiful it is, the more attracted you are to it because, you see that that's a playground you want to play in. But the more I read, whether right or wrong, the more I realize that almost everything is about risk. This whole thing about is risk management. I mean, one can perhaps rewrite this whole treatises that people have done simply from the risk point of view and simply saying, how does one manage risk? That is my theory of finance, and let's do it that way instead of everything else that people have done. And it's just a starting point as risk. So yeah, no, I understand, and that is written when you read Kahneman, Tversky, and all these people who have done all these studies on how people perceive the notion of risk, loss aversion, matching the probabilities. You did mention that certain number of people even try to, in their investments, match the probabilities of the biased coin. So this was something that Andrew Lowe in Adaptive Market Hypothesis book talks about, and in many talks that he gave, he was talking about this thing that 60-40 of like heads up 60%, tails up 40%. Majority of people who were not knowledgeable about this idea of, well, obviously I should put my bet on heads up all the time. They were every experiment they did, mostly all of them showed that they were matching the distribution. They were matching the biasness of the coin. They were going 60-40, 70-30. They were going 70-30. They were converging to 70-30.
You mean they were betting 70% of the time
Half
on
the
heads
time
and
on the head. That's right.
30% on
That's
tails?
right. That's right. That's right. That's right. They were matching, and this is this matching bias that, oh, so this is the way to be. So I have to be 70%. It's fascinating. I mean, this risk and human behavior and all of that. But okay, let me then not talk too much and let the audience, please, if anyone has any questions, please raise. Yes, Mauricio, please go ahead.
Hi, everyone. Victor, nice to meet you, and thanks so much for the book. Very illuminating, really incredible. I think I have two things. One is a comment, and the second is a question. The comment is that I think your book came out in a very timely manner, or at least that's how I perceived it. So it was really interesting to read, the first few chapters of the book regarding the Merton share and like the coin flip experiment. So week after I started reading your book, on Jane Street YouTube channel, sometimes they post examples of like quantitative trader interview questions, right? And this is a question that comes in very different flavors. And it was very funny that I had just read the first three chapters of your book, and then I watched this video of a sample interview from Jane Street. And it turns out that the interviewer was asking the candidate, okay, you have a fair coin, but if it lands on whatever if you got the bet right, you're gonna get two times the money that you bet. But if you lose, then you're gonna lose the entire amount of the bet, right? So if you start with $100 and you bet $10, you're gonna get your $10 back plus $20 if you get it right. Otherwise, you're gonna lose $10, right? And you're gonna end up with $90, right? So the question is like, what is the optimal bet size to maximize your expected profit? And between the interviewer and the interviewee, they seem to suggest that the best strategy is to bet it all the time, which I found so weird after reading, the Merton share and the mathematics that you showed, right? Because yeah, I mean, in theory, it might make sense to bet it all, but at the same time, you're gonna go bankrupt if you fail the first bet, right? So there was no notion about like optimal bet size throughout the entire video. There was no notion about, this idea of gamma, right? Like what's your risk aversion. Anyways, I just thought it was very illuminating to just watch that interview and see that maybe, like you said, right, maybe there's like a generalized bias in the industry where we have like established equations or established like very complicated models for certain things, and maybe there are these underappreciated items or pieces of wisdom that I think your book does a pretty good job at racing. So that was my comment. Just very interesting.
Thank you. That's great. Yeah, that's really interesting to hear. Thank you.
Yeah, and then the question, I think I'm very interested to hear a little bit more about, like, there's this part of the book where you talk about like comparing the dynamic versus the static strategies when it comes to like adjusting your allocations, right, on the risky assets versus the low risk assets. Do you have any advice as to like automatic tools or software that we could use, as personal investors, not as people that work in the finance industry, but just like individual investors? Are there any tools that you would recommend us using for doing that kind of rebalancing, maybe on a monthly basis, maybe on a quarterly basis, especially for people, that don't do active portfolio management but we have our savings with our retirement accounts and all that. Do you have anything that could help us like kind of like automate or work through that process?
Yep. So, we just wrote a paper. I just wrote an article a couple weeks ago where, like 3 or 4 weeks ago, I was in Minneapolis at a conference for Bogleheads. So these are all DIY investors, do-it-yourself investors who, come together to celebrate John Bogle and what he did and index investing in general. And, we were talking and I was giving a talk, or I was in a chat with this writer from Morningstar, Christine Benz, and she was saying, why do you think that dynamic index investing or dynamic asset allocation is better, makes more sense? And I explained that, that if you have an expected return relative to the safe asset and that's changing and the riskiness of your assets are changing, then, given a constant sort of risk aversion or utility function, your asset allocation will change over time. And that just is kind of the normal rational thing to do, But then, like as after I left and was thinking about it more and so on, I was like, if you're a do-it-yourself investor, you're committed to being a do-it-yourself investor and you want to do it yourself, do the dynamic asset allocation yourself. It's a bit of work of building, of getting the data. The data is available. The earnings, cyclically adjusted earnings yields are available on U.S. and non-U.S. equities. We can easily see what the real rate of return is on safe U.S. treasuries, to the extent they're safe. And you know, there's all kinds of ways that we can, you know, that is really obvious if we're in a high risk or a low risk environment, and to overweight or underweight, you know, depending on how risky the environment is. You know, we can use we can just look at VIX. You know, we can just get VIX up on Yahoo Finance, or we can look at some realized vol, whatever. So, you know, that unfortunately, I think for a DIY investor, you'd have to kind of build this yourself. It's doable, but it's not doable for 99% of the people, in honesty. You know, that it's like doable, but it's doable for somebody that's really, you know, kind of a finance specialist. You know, you could, you know, it's also possible, like, for instance, we just publicly put our stuff out there, you know, so somebody could just follow what we're doing, that they don't want to hire us to do it for them. You know, we have all of the stuff transparent, available on our website, so somebody could shadow themselves what we're doing and make sure that they understand how we're coming up with our numbers, and just go to our website and do that. So that's available to say, okay, well, I'm just going to follow the asset allocation that these guys would do for me if I were a client, and that's there. You know, away from, you know, just either following what we're posting with our tools or building something yourself. You know, yeah, there's not, you know, unfortunately, there's not anything else, but it is easy to build it yourself if you're, you know, kind of, knowledge, you know, if you have that level of knowledge and comfort with, you know, spreadsheets or databases or whatever. But it was interesting. I think I said this, you know, earlier, and just as I was stopping in one of the segments, you know, where I went to ChatGPT and was like, hey, how much should I have invested? And it just doesn't, you know, like, this idea that your asset allocation should depend on the expected return and risk is just not out there. And then, you know, a lot of people will say, well, that sounds great, but how do I know what the expected return is of equities? And the answer to that is, if you don't know what the expected return is of equities, you better not invest in them. Like, how can you invest, you know, how can you come, you know, that how can you come to any decision if you don't have a view about the expected return and the riskiness? So, and, you know, I think that there is a lot of consensus out there, you know, that if you didn't want to, you know, if you wanted to sort of, like, another thing that a person could do is that you can look at the capital market assumptions of 10 large institutions, you know, Vanguard, BlackRock, Morgan Stanley, whatever. You just type in capital market assumptions, Morgan Stanley, and all of these large financial institutions are publishing their expected return for the different asset classes. And, you know, like, some, you know, like, you want to have some kind of methodology for averaging them together. You know, I don't think I would do a straight average. I think I would do something of throwing out highs and lows. You know, I think that, you know, all the different institutions that are putting out expected return numbers, you know, are not always completely truth seeking, you know, that there's other incentives that they can have, but overall it's pretty good, you know, it's pretty reasonable. So you could also get expected returns, you know, just off of their websites or from our website too. You know, we publish the capital market assumptions. But so, yeah, I think it's doable, but, you know, I mean, the easiest way to do it would be to, like, just shadow what we're doing. And yeah, it's amazing. I mean, it's just amazing. Like, how is it, you know, how is it that there's not a lot of people doing what we're doing? It's really weird and kind of scary in a way. Like, you know, maybe we just are so unbelievably wrong about something. I don't know, you know, what it is, but, you know, it's like, it's amazing, you know, that, you know, that nobody is really doing this sort of thing that we're doing in this sort of simple, transparent way. So, yeah.
Yeah. Thanks so much, Victor. I appreciate it. And
Yeah,
congrats on
pleasure.
the book. And yeah, we'll definitely follow your updates on your website. Thank you.
Pleasure.
Interesting what you said. Of course, you said why people are not following the same methodology or methodologies close to that you are following, and that seems the obvious way to go. But one other thing that reminded me of was how easy it is for people to invest sometimes. Because you did say that if you don't know the expected return, if you don't know the amount of risk involved, even if the risk is not tangible, risk is still there, risk of losing everything you have invested or half of what you've invested or anything along those lines that can be, you know, turned into some, using some sort of a metric, can turn into a number that you can play with and you can look at. But how easy it is for people to invest, say, $500 or $600, $700 into a share of a stock without even thinking too deeply about that or at all about that, compared to how much the same person would spend time and energy spending the same 500 on a TV or a refrigerator or something like that. And people who have done experiments like that, it's just amazing that they, on one hand, when you do that, when they go to buy something like that, they do their research, they look at consumer reports, they search all sorts of refrigerators, Samsung, LG, oh my God, I have to know all the details. Whereas the same 700, when it is buying Apple shares or whatever, done. Well, press. Just
Amazing.
kind
Yeah,
of
it really
human
is.
behaviors.
I mean, it's interesting that, there's just so much kind of positive sum welfare gain that we can get in our society from people making better financial decisions.
Mm.
I haven't quantified it. I'm kind of interested in just trying to estimate a bunch of different things. I mean, one thing is that $40 billion a year is spent on lotteries. And I think that those $40 billion are more or less complete deadweight loss, and and it's almost entirely falling on the lowest income people. And, of course, there's the, big, you could have a big debate among philosophers and economists and political economists saying, well, isn't it just the case that anything that anybody does voluntarily is okay? I understand that, and maybe, I'm a little bit sympathetic to that, but the information isn't quite there either, and I think that, like, when I was younger, I smoked, and I still, I mean, it's been, I don't know, 40 years that I stopped smoking. And every once in a while, I feel like I still kind of feel like, oh, it'd be nice to, so, but now, you pick up a pack of cigarettes and you look at it, or cigars or anything. And, there's like somebody that's actually, dying and falling apart. It's like, right. And it's like, if you smoke this, that's, you better keep that in mind. That's where you're going. I know it's effective. I know that it affects me. And yet, we can go to Vegas, right? And we go to the slot machine and you pull the slot machine. And why doesn't the slot machine say that at a minimum? Why doesn't the slot machine say, every time you put $1 in here, your expected gain is 93 cents? I'm sorry, your expected cost, whatever, I don't know, your expected cost is 7%. You're every time you roll this thing, you're losing 7% expectationally of what you put in. And, and maybe there should be a picture of some, homeless person, just
That's right.
lying there, lying on the ground. Like, if you keep doing this,
This
this is
is
going
where
to
you
be
go.
whatever. Like, and why now I know why Nevada, why, that it's kind of obvious, I guess, why the Nevada State Gambling Commission isn't requiring that. But I don't know, why isn't there a federal requirement? Why doesn't the FTC or whatever, require that kind of disclosure? So I think there's a huge amount of negative sum, like deadweight cost. I mean, I think that all the $40 billion that's going into these state lotteries is actually just deadweight loss to these people. There's no utility curve. There's no way that any of this makes any sense, whatsoever. And, there needs to be, like, some education around it at a minimum. My sentiments and emotions are all with letting people have choice, but, but informed choice. The cigarette package should really say, if you smoke this, you have a 10% chance of becoming this guy. Like, it shouldn't, the way that it's actually there is really saying, if you smoke this, there's 100% chance that that's where you're going.
Eventually,
But anyway, I think that, one step that we can do in the right direction is just, just require that same disclosures. I mean, what's the matter with like, I don't know, it doesn't bother me to require businesses and so on to disclose information to people. I kind of feel like that's the right thing to do, is just force the disclosure, because they don't want to disclose it. There's no way that people are going to play as much of the slot machines if they knew that there was a 7% drag. And I don't even know what the drag is. Like, I mean, the drag could be 12%. I mean, it's unbelievable that they don't. Is there any commission that says the drag on the slot machine has to be X? it's unbelievable, right? And meanwhile, and you should have the same thing, on the blackjack table and on the craps table and on the roulette wheel, and it shows you what that is. And then, we need to bring it into, the brokerage account. It's like you are buying these options, you're buying these one-day options on Apple. It's a more complicated thing, but somehow to, explain like, you are wasting your wealth.
No, it's definitely true. And whatever they do, they only do that just to cover the legalities, just to cover the part that is with certain inspecting institutions, simply to say, hey, if you want permission to do futures trading or, options trading, it is a highly risky, you need to know about the risks. That's it. What are the risks? What is an example of me getting ruined by, something that on the face of it doesn't look that risky at all? Or what will be the consequences? Here is a video, short video that shows you how one can rapidly lose money on this.
Yeah,
No,
yeah.
it's
It's
just
just
that you
too, it's
yes,
all,
I
it's
know.
all too
Yeah.
abstract. Yeah. We can reach people, we need to, like, I think that that so many people have given up on financial literacy. Like everybody that's involved in financial literacy is not everybody, but most people are very pessimistic, and most educators are very pessimistic on on being able to impact financial literacy. But I say, let's try anyway. I mean, we
Sure.
do have, like we can get, like probably everybody in the United States somewhere has seen one of these stupid shark videos, the shark, 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 or some
Yeah.
cat video or something, right? Like you can reach people.
Yep.
Taylor Swift has 250 million followers. A lot of them are in America. So, like it is possible to reach people, and the messaging is really simple, in many ways. And there's so much dead weight loss. So I don't know. I think, it's not about PBS. I mean, PBS is great, and, I'd love to see them do more,
Sure.
but it's not, it's, that we have the mechanisms to reach a lot of people. And, I think it's just it's just a positive sum opportunity to improve our welfare, and people are just complaining so much about this and that. And it's like, geez, like don't go and buy a Cadillac with a car loan, if your income is $40,000 a year. Like, what are you doing? And then you keep your money at Wells Fargo earning zero, and you got a 20% car loan. And what are you doing?
Yeah.
Like,
Yep.
that these are things that we should not allow, we should not allow it in the system.
Yeah, no, that is very true. And so many of the disasters that we have witnessed in the past basically emerged as things like this in a larger scale,
Yeah, yeah,
higher amplified version of what.
yeah. So, like one thing that I've been, in terms of, thinking about the future and other
Yeah.
research and writing and thinking, one thing that I've really been had in my mind a lot recently is this, is around what's known as the Oman agreement or disagreement principle. I don't know, have you ever come across that? So, Robert, the game theorist, he's in
Yes.
his 80s now. And, he published a paper in 1976.
Mhm.
I think it's called the agreement principle or the disagreement principle. And basically he says, or he shows in a very short, in a very short proof, if people share a common objective of truth seeking, and they are aware of the prior probabilities of themselves and these other parties, and they trust that these other people are also rational and that they're rational, that they must come to agreement on on the posteriors, that
Uh,
they'll keep like
mm,
updating whatever and kind of get to these,
converted.
so you cannot, so under those conditions you cannot agree to disagree, that you will agree, and it's like a very elegant, simple proof that I don't really understand, but I can see that it's elegant and short. And it's just had me thinking a lot, about there are just so many situations where, it feels that, we should be able to get together and agree on certain things. Like, for instance, the expected return of the stock market, it feels like, a bunch of people who have thought about it should be able to come together and really kind of settle on the distribution of the estimate. And the interesting part of, the proof or whatever is that you don't need to share any private information. So, he gives this example, of two detectives, that are investigating a murder, and each one of them does their own investigation. They go out and they get all this stuff, and then they come together, and then Detective A says, I think the probability that person one did it is this, and person two did it is that. And they're different, they have different, different priors, but they're known to each other. But they don't exchange any information about why they think that these different people did it with different likelihoods. And just given that, and if they're truth seeking, and if they trust each other to be rational and to kind of know that they know that that person knows that they know, etc., that they must eventually agree on common posterior for the probabilities that those people, that the different suspects committed the murder, for instance. And it's very elegant, and I think that it kind of followed from some other papers by other people like de Groot, another economist, etc., where he talks about how you would get consensus among people. What are the conditions to arrive at consensus, in terms of weighting, which is a kind of a simpler to understand paper that came before it. And anyway, I just think it's like, that it's one of these things that, gosh, it's 50 years, it's like 50 years since it was out there. And, very few people that I talk to, have heard about it. I don't really understand it, so I'm trying to learn more about it. I'm trying to find some game theorists that could really explain it to me and make sure that I do understand it. But anyway, I'm hoping to talk about it more and get people thinking about it more. And it's like really interesting when we can't agree. There's this obvious times when we can't agree on things, and because of the principle, it really helps us to understand why we can't agree. So if we do agree to disagree, then it means that we don't have a shared objective. It means that we don't trust each other to be rational. We don't, so it's really interesting because it also really highlights the simple conditions where we're not reaching an agreement. And why are we not reaching an agreement? Well, it's because of those things. And it kind of really de-escalates argument and agreement in some ways. So anyway, that's something that if you were going to say, what are you thinking about these days?
That was my last.
I thought I'd jump ahead and tell you that. So anyway, great. So I guess we're out of time. It's been really a pleasure.
Well, thank you very much for being here, for spending this hour with us. That was really fascinating conversation. And that was great. So I think that I'm going to explore that myself, and probably I will also, if I explore and get something out of that, I will also post it here on Quantopian for people to see, maybe to get people's reaction as well. Because those consensus building things, as you know, have also evolved into other directions in cryptocurrencies and blockchain and things like that, where it is much more of a mechanized version of things. But that goes back to Lampert's work in agreement on distributed systems, when people are unaware of each other's decisions, but based on the assumptions of truthfulness, how much truthfulness is there. And there are also links to mechanism design problem, which is kind of an auction theory in some sense. Somewhere where there is an agreement on the value of something of some form, and that people are either forced by that mechanism to tell the truth, because telling the truth is actually to their best benefit. That is the sort of the highest profit will come from telling the truth, as the victory auctions and things like that. So there is a fascinating field of this distributed nature of people who do not, as you said, know about the details of each other, but they have their priors or their preferences out there for people to see. And then
interesting. I never thought of that connection to to whatever to blockchain. I never thought about that. That's very interesting. Yeah.
That was
so I hope I can keep learning about this more, and that it can be helpful for people. Great.
Will be. Okay, wonderful. And have a wonderful night. And we'll talk hopefully later.
Thank you very much.
Thank you everyone for being here. All right. Thanks. Bye.
Thanks. Bye.